The world has never reported higher profits. Markets stand near record levels. Corporations claim resilience. Governments claim stability. And yet, beneath the numbers, something is breaking. This is not a story about recession. This is a story about an economy that looks rich, but no longer works. The world appears richer than ever. Market indices hover near historical highs, corporate earnings reports announce record profits, and balance sheets look stronger on paper than at any other moment in modern history. Headlines speak the language of abundance. Trillions of market capitalization are created within days. Governments proudly cite gross domestic product figures that continue to expand. Central banks publish balance sheets that dwarf anything seen in previous decades. From the outside, this looks like an era of unprecedented prosperity. But this perception is built almost entirely on nominal measurements. Wealth today is defined by price, not by substance. Assets are worth more because currency units are worth less. When liquidity floods the system, everything measured in money appears larger, even if nothing real has improved. This is the foundation of the illusion. The global economy is not growing richer in terms of productive capacity, resilience, or stability. It is growing richer only in accounting terms. Over the past years, the combined valuation of global equity markets has expanded by amounts that would have taken decades in previous cycles. Yet during the same period, productivity growth has stagnated across most developed economies. Manufacturing output has failed to keep pace with financial expansion. Infrastructure investment lags behind depreciation. Real wage growth remains weak despite tight labor markets. The numbers rise, but the underlying engine sputters. Central banks play a critical role in sustaining this appearance. Through years of ultra-low interest rates and large-scale asset purchases, they have transformed financial markets into liquidity-driven systems. Capital no longer flows primarily toward productive investment. It flows toward assets that benefit most from cheap money. Stocks, real estate, and bonds inflate simultaneously, creating the impression of universal wealth creation. But this wealth is conditional. It exists only as long as liquidity remains abundant and confidence remains intact. Corporate balance sheets illustrate this contradiction perfectly. Large firms report impressive profit margins and rising earnings per share. Yet a significant portion of these gains comes not from organic growth, but from financial engineering. Stock buybacks inflate per-share metrics without increasing productive output. Cost-cutting replaces innovation. Debt is rolled forward instead of reduced. In many cases, profits exist alongside rising leverage, not declining risk. At the same time, governments celebrate expanding tax bases driven by nominal growth. Higher prices generate higher revenues, even when real activity remains flat. This allows public spending to increase without immediate political cost. Deficits appear manageable because debt is measured against inflated economic output. But the real burden of that debt has not disappeared. It has merely been postponed and obscured. The global news cycle reinforces the illusion. A new market high becomes evidence of economic strength. A strong quarterly earnings season is framed as proof of recovery. Currency depreciation is reframed as competitiveness. Inflation is described as temporary. Each narrative supports the next, creating a self-reinforcing story that prosperity is not only real, but accelerating. Yet beneath this surface, structural stress accumulates. Household savings rates decline as living costs rise faster than incomes. Credit card balances grow even in economies with low unemployment. Small businesses struggle to access affordable financing, while large corporations borrow freely. Asset owners benefit from appreciation, while wage earners face erosion of purchasing power. The distribution of wealth becomes increasingly distorted, even as total wealth appears to expand. This is the core of the paradox. An economy can grow richer in aggregate while becoming poorer in function. Nominal indicators improve while real systems weaken. Financial wealth multiplies while economic resilience declines. The illusion persists because markets respond to liquidity, not sustainability. As long as money is abundant, prices rise. And as long as prices rise, the narrative of prosperity remains intact. Historically, such periods are not rare. They appear whenever financial expansion outpaces real growth for extended periods. What makes the current moment unique is scale. Never before has so much liquidity been injected so quickly into the global system. Never before have asset prices diverged so far from underlying productive capacity. Never before has so much perceived wealth depended so heavily on confidence rather than cash flow. The danger lies not in volatility, but in complacency. When wealth is defined by rising prices rather than rising output, risk becomes invisible. Stability becomes assumed. Policymakers mistake market performance for economic health. Investors mistake valuation for value. Corporations mistake access to credit for strength. The illusion of record wealth is powerful precisely because it feels measurable. Numbers confirm it. Charts validate it. But numbers alone do not tell the truth of an economy. They tell the truth of a system saturated with money. And money, when detached from production, can expand far beyond reality. This is not a collapse. Not yet. It is something more subtle and more dangerous. It is a system drifting away from its foundations while celebrating its reflection. The world looks richer than ever, but the strength behind that wealth is thinner than it appears. Corporate profits have never looked stronger. Earnings reports arrive with confident language, polished charts, and reassuring forecasts. Margins appear wide. Cash positions look impressive. Market reactions are swift and positive. To the casual observer, modern corporations seem not only profitable, but resilient, disciplined, and structurally sound. This is the second layer of the illusion, and it is deeper than the first. Profit today no longer represents strength in the traditional economic sense. It represents access. Access to capital, access to refinancing, access to financial structures that allow weakness to be delayed rather than resolved. The modern corporate profit is often less a result of productive success and more a byproduct of financial conditions. Over recent years, many of the largest global corporations have reported record earnings during periods of historically weak demand growth. This alone should raise questions. In a healthy expansion, profits rise because output rises, efficiency improves, and new value is created. In the current environment, profits rise even as volumes stagnate, customer purchasing power erodes, and long-term investment slows. The explanation lies not in operational excellence, but in financial distortion. A major driver of this distortion is the cost of capital. For an extended period, borrowing costs remained artificially low across the developed world. This allowed corporations to refinance debt endlessly, replacing old obligations with new ones at similar or even lower interest expense. Balance sheets expanded without triggering immediate stress. Debt did not disappear, but its weight became less visible. In accounting terms, leverage increased. In perception, risk declined. Stock buybacks became the signature mechanism of this era. Instead of reinvesting profits into capacity, research, or workforce development, companies redirected cash toward repurchasing their own shares. This reduced share counts, mechanically boosting earnings per share even when total profit remained flat. Executive compensation rose alongside these metrics, reinforcing the behavior. From the outside, profitability improved. Internally, productive capability often did not. At the same time, cost reduction replaced growth as the primary strategy. Labor expenses were minimized through automation, outsourcing, and temporary contracts. Supply chains were optimized for efficiency rather than resilience. Inventory buffers were eliminated. Each decision improved short-term margins while increasing long-term fragility. Profitability rose, but structural strength declined. Financial statements captured none of this risk. They recorded earnings, not exposure. They showed margins, not dependency. They measured outcomes, not sustainability. Investors, conditioned to respond to quarterly performance, rewarded the appearance of discipline. Share prices rose. Market capitalization expanded. The feedback loop strengthened. Another critical factor is pricing power, driven by inflationary conditions. As costs increased across the economy, large corporations with dominant market positions passed these increases onto consumers. Revenues rose in nominal terms, even when unit sales stagnated or declined. Profit margins were preserved, not through innovation, but through scale and market control. Smaller competitors lacked this ability and were gradually squeezed out, further concentrating power and profitability at the top. Meanwhile, interest expense remained manageable due to favorable refinancing conditions. Even heavily indebted firms avoided stress as long as credit markets remained open. Profit statements looked healthy, but they rested on the assumption that refinancing would always be available. The ability to roll debt forward became as important as the ability to generate cash flow. In some sectors, it became more important. This is where the concept of profit without strength becomes most dangerous. A company can report strong earnings while being fundamentally dependent on external financial conditions. Its survival may hinge not on customer demand or operational efficiency, but on interest rates, market sentiment, and central bank policy. This dependency is invisible during periods of stability. It reveals itself only when conditions change. Global news reinforces the misinterpretation. When major corporations announce earnings beats, the narrative focuses on execution and leadership. When share prices rise, it is framed as validation. Rarely is attention given to the composition of profits or the source of resilience. Financial media celebrates outcomes without examining foundations. Even capital expenditures, when they occur, are often defensive rather than expansionary. Investments aim to maintain margins rather than build future capacity. Technology spending focuses on automation and cost reduction. Growth initiatives are selective and cautious. This is not the behavior of confident builders. It is the behavior of managers navigating a fragile system. The result is an economy dominated by firms that appear profitable but are increasingly hollow. They are optimized for financial performance, not economic contribution. Their profits signal survival under current conditions, not robustness across cycles. As long as capital remains cheap and markets remain liquid, this model functions. But it functions by suppressing risk, not eliminating it. The first part of this chapter reveals a crucial truth. Modern corporate profits often reflect the environment more than the enterprise. They are a mirror of financial policy rather than business health. Strength is assumed because numbers are high, but high numbers alone do not indicate durability. They indicate alignment with a system that rewards financial maneuvering over productive strength. And systems built on alignment rather than resilience rarely endure unchanged. The fragility of profit becomes clearer when viewed across sectors rather than individual firms. Entire industries now operate on margins that exist only under specific financial conditions. Technology, real estate, transportation, retail, and even parts of manufacturing have become structurally dependent on low financing costs and constant access to credit. Profitability is no longer an intrinsic quality of the business model. It is a conditional state. Consider how many corporations would remain profitable if refinancing were interrupted, even briefly. Interest expenses that appear manageable today would expand rapidly under tighter conditions. Projects justified under one cost of capital become unviable under another. What appears as strong profitability is often a narrow equilibrium, maintained only while monetary conditions remain favorable. This dependency changes corporate behavior in subtle but important ways. Management decisions prioritize optics over durability. Balance sheets are optimized for market perception rather than stress tolerance. Liquidity is hoarded not as a buffer for investment, but as insurance against volatility. The corporation becomes less an engine of growth and more a defensive structure designed to survive within a fragile system. Accounting conventions amplify this illusion. Profits are reported without context. Debt maturities are buried in footnotes. Exposure to refinancing cycles is rarely emphasized. Earnings calls highlight adjusted metrics that exclude inconvenient realities. Investors are trained to focus on headline figures rather than underlying cash flow dynamics. The result is a collective blindness to structural weakness. Global statistics reinforce this trend. Corporate debt as a share of economic output has expanded dramatically across advanced economies. At the same time, the quality of that debt has deteriorated. Covenant protections have weakened. Maturity profiles have lengthened, postponing risk rather than resolving it. A growing share of corporate obligations depends on continuous market access rather than amortization. Profit exists alongside obligation, not independence. The labor market reveals another dimension of profit without strength. Many corporations maintain margins by suppressing wage growth while relying on flexible labor arrangements. Employment becomes more precarious even as profits rise. Workers contribute to earning stability while bearing economic volatility themselves. This dynamic supports short-term profitability but undermines long-term demand. When wages stagnate, consumption weakens. When consumption weakens, growth relies increasingly on credit. Innovation, once the engine of corporate strength, becomes secondary. Research and development spending continues, but its purpose shifts. Instead of creating new markets or expanding productive capacity, it focuses on defending existing positions. Incremental improvement replaces transformative growth. The system rewards predictability over ambition. Profitability becomes maintenance, not expansion. This behavior is rational within the current framework. When future conditions are uncertain and financing is cheap, preserving margins is safer than risking capital on long-term projects. But collectively, this rational behavior produces stagnation. An economy dominated by defensive profit cannot generate dynamic growth. It can only extend the present. Financial markets misinterpret this stability as strength. Low volatility is mistaken for resilience. Predictable earnings are mistaken for sustainability. Valuations rise because risk appears contained. But risk is not gone. It is displaced. It accumulates beneath the surface, tied to refinancing schedules, interest rate sensitivity, and consumer fragility. The paradox deepens when profits rise during economic stress. Periods of disruption increasingly coincide with strong corporate earnings. Cost-cutting accelerates, pricing power increases, market concentration intensifies. The strongest firms emerge stronger, not because the economy improves, but because competition weakens. Profit becomes a signal of dominance, not health. This concentration carries systemic consequences. When profitability depends on scale rather than innovation, barriers to entry rise. Smaller firms struggle to compete. Economic diversity declines. The system becomes efficient but brittle. A shock that affects dominant players reverberates widely. Strength at the top masks vulnerability below. At a macro level, this dynamic distorts policy responses. Policymakers observe strong corporate performance and conclude that the economy is resilient. Support is withdrawn prematurely or misdirected. Structural issues remain unaddressed. The system continues to rely on conditions that cannot persist indefinitely. Profit without strength is not fraud, it is adaptation. Corporations respond logically to the incentives they face. The problem lies in mistaking adaptation for health. A firm optimized for a specific environment may perform exceptionally well within it while remaining unprepared for change. When conditions shift, performance can deteriorate rapidly. This chapter does not argue that profits are meaningless. It argues that they are incomplete. In the current system, profit measures success within the rules, not robustness beyond them. It reflects alignment with financial structures, not independence from them. It signals survival under present conditions, not endurance across cycles. The danger emerges when profit becomes the sole indicator of strength. When investors, executives, and policymakers treat earnings as proof of resilience, they overlook dependency. They ignore leverage. They discount fragility. The system appears stable precisely because its weaknesses are hidden behind impressive numbers. As long as credit flows freely and markets remain liquid, this model persists. Profits continue, valuations rise, confidence holds. But the foundation remains conditional. Strength exists only within a narrow range of outcomes. Outside that range, the illusion dissolves quickly. The modern corporation is not weak, but it is not as strong as it appears. Its profits reflect a world shaped by financial policy, not one built on durable growth. And when the environment that sustains those profits changes, the difference between appearance and reality becomes impossible to ignore. Money is everywhere in the system, yet it is nowhere that it is most needed. This contradiction defines the modern economy more clearly than any headline or market index. Liquidity appears abundant when viewed from the perspective of financial markets, corporate treasuries, and central bank balance sheets. At the same time, it is increasingly scarce where real economic activity depends on it. This is not a shortage of money. It is a failure of circulation. Over recent years, global liquidity has expanded at a pace without historical precedent. Central banks injected vast amounts of capital to stabilize markets, support governments, and prevent systemic collapse. Banking systems were flooded with reserves. Asset markets absorbed this liquidity almost immediately. Prices adjusted upward. Valuations expanded. From a distance, the economy looked well-funded. But liquidity is not simply the presence of money. It is the ability of money to move, to change hands, to support transactions that generate real output. In this sense, the modern economy is increasingly illiquid, despite being saturated with capital. Money accumulates in specific nodes and fails to circulate outward. It pools at the top and stagnates. Corporate balance sheets reveal this concentration clearly. Large firms hold substantial cash reserves while simultaneously maintaining high levels of debt. This is not contradictory. It reflects a system where access to credit is easier than access to sustainable demand. Cash is held defensively, not deployed productively. Investment decisions are postponed. Expansion is delayed. Liquidity becomes insurance rather than fuel. Households experience the opposite reality. Savings rates decline even as nominal incomes rise. Living costs absorb a growing share of earnings. Credit fills the gap between income and expense. Consumers remain active, but increasingly dependent. Spending is sustained not by wage growth, but by borrowing and asset appreciation. Liquidity reaches households indirectly and often conditionally. Small and medium-sized businesses sit at the center of this imbalance. They are expected to generate employment, innovation, and local growth, yet they face tightening financial conditions. Access to affordable credit becomes uneven. Lending standards harden, risk tolerance declines. While large corporations refinance with ease, smaller enterprises struggle to secure funding for expansion or even survival. The result is an economy where capital exists, but growth mechanisms weaken. The velocity of money captures this dynamic more accurately than aggregate supply. Despite massive increases in liquidity, the rate at which money changes hands has declined across advanced economies. Each unit of currency supports fewer transactions over time. This signals hesitation. It reflects a preference for holding rather than spending, for preserving rather than risking. Liquidity without movement becomes inert. Inflation complicates this picture further. Rising prices increase nominal revenues and expenses simultaneously. For firms of pricing power, inflation preserves margins. For households, it erodes purchasing power. Money loses value as it moves downward through the system. By the time liquidity reaches consumers, it carries less weight. The circulation loop weakens with each cycle. Global trade patterns also reflect this imbalance. Supply chains recover in price, but not in resilience. Trade volumes fluctuate while costs remain elevated. Export revenues rise in currency terms, but real gains are limited. Capital accumulates at multinational hubs, while peripheral economies face currency pressure and financing constraints. Liquidity moves across borders, but stability does not. Financial markets interpret this environment incorrectly. Abundant liquidity suppresses volatility. Risk premiums compress. Asset correlations rise. The absence of stress is mistaken for health. But this calm reflects stagnation rather than strength. When money stops moving, prices can remain high even as activity slows. Markets float above the real economy, disconnected yet dependent. Labor markets provide another signal. Employment levels may appear stable, but job quality deteriorates. Temporary contracts expand. Wage growth lags inflation. Workers remain employed, but financially constrained. Liquidity supports employment statistics without supporting living standards. This creates a fragile equilibrium where participation persists without security. Governments attempt to bridge this gap through fiscal measures. Transfers, subsidies, and targeted programs inject money directly into consumption. These measures provide temporary relief, but they do not restore circulation. They replace private demand with public spending. Liquidity enters the system, but exits just as quickly. Structural weakness remains. The paradox deepens when interest rates rise. Tighter policy is intended to control inflation, yet it further restricts circulation. Borrowing becomes more expensive, investment slows, debt servicing absorbs cash flow. Liquidity concentrates even further among those least likely to spend it. The economy becomes less dynamic precisely when activity is most needed. This is how an economy becomes cash-rich and cash-starved simultaneously. Money exists in aggregate, but not in motion. It is present on balance sheets, but absent in daily transactions. It inflates asset values while bypassing productive exchange. Growth becomes nominal. Stability becomes artificial. The first part of this chapter exposes a critical truth. Liquidity is not a stock. It is a process. When that process breaks, no amount of money can restore economic vitality. The modern system suffers not from a lack of capital, but from its misallocation. And as long as money remains trapped where it cannot circulate, the economy will continue to weaken beneath the surface of abundance. In the next phase, the consequences of this stalled circulation become impossible to ignore. When circulation stalls, the effects do not appear as sudden collapse. They emerge as distortion, delay, and decay. The economy does not run out of money. It runs out of momentum. Transactions slow. Decisions are postponed. Risk tolerance fades. Growth becomes increasingly dependent on intervention rather than initiative. One of the clearest signals of this breakdown is the growing divergence between financial liquidity and transactional liquidity. Financial liquidity allows assets to be bought and sold quickly without significant price movement. Transactional liquidity allows goods, services, and labor to move efficiently through the economy. The modern system has an abundance of the former and a shortage of the latter. Markets trade freely, economies hesitate. Banks illustrate this contradiction sharply. Reserves are ample, capital ratios appear strong, yet lending growth remains muted. Credit is available in theory, but selective in practice. Institutions prefer low-risk, collateralized exposure over productive but uncertain activity. Money is safest when it stays close to the financial core. Each layer of risk added as capital moves outward reduces its willingness to travel further. This creates a tiered economy. At the center, liquidity is cheap, abundant, and renewable. At the edges, it is scarce, expensive, and conditional. Large firms operate within the inner circle, recycling capital among themselves. Smaller firms and households exist outside, dependent on trickle-down effects that arrive weakened and delayed. The system functions, but unevenly. Consumer behavior adapts accordingly. Spending becomes cautious even when employment remains high. Purchases shift toward necessities. Discretionary demand becomes volatile. Confidence erodes quietly. This is not fear-driven panic. It is rational restraint. Households sense instability even when headlines remain optimistic. They respond by conserving cash, reinforcing the slowdown in circulation. Asset appreciation masks this behavior temporarily. Rising home values and equity prices create the illusion of wealth, encouraging consumption through perceived net worth rather than income. But this form of liquidity is fragile. It depends on prices continuing to rise. When appreciation slows or reverses, the spending it supports disappears quickly. Liquidity vanishes because it was never truly liquid. The global dimension intensifies the problem. Capital flows seek yield and safety, often moving away from productive but volatile regions towards stable financial centers. Emerging economies face capital outflows even as their need for investment grows. Currency depreciation raises import costs and debt burdens. Liquidity drains from where growth potential exists and accumulates where returns are protected. The imbalance becomes self-reinforcing. Policy responses struggle to address this asymmetry. Monetary tools influence the price of money, not its direction. Lower rates encourage borrowing, but do not guarantee productive use. Higher rates restrain inflation, but also suppress circulation. Fiscal tools can inject demand, but often lack precision and permanence. Each intervention treats symptoms rather than structure. The result is a system increasingly dependent on continuous support. Growth requires stimulus. Stability requires reassurance. Markets expect intervention. Economies adapt around it. Liquidity becomes administered rather than organic. When support is reduced, activity falters. When support is expanded, distortion increases. The range of effective policy narrows. This environment reshapes expectations. Businesses plan for shorter horizons. Households delay long-term commitments. Investment favors flexibility over scale. Productivity gains slow. Innovation becomes incremental. The economy survives, but it does not advance. It rotates within a confined space, sustained by liquidity that does not circulate freely. Crucially, this stagnation coexists with high asset prices. This confuses interpretation. Observers equate market strength with economic health, but markets reflect liquidity conditions, not transactional vitality. They can remain elevated even as the real economy weakens. This divergence persists until circulation fails visibly. When that moment arrives, it rarely announces itself loudly. It appears as persistent underperformance. Growth forecasts are revised downward repeatedly. Earnings stagnate despite strong margins. Employment remains stable, but wages lag. The economy does not crash, it exhausts. This exhaustion has consequences for social and political stability. When money exists but feels unreachable, trust erodes. Institutions are questioned. Policy credibility weakens. Expectations adjust downward. The economic narrative shifts from opportunity to preservation. This shift marks the true cost of stalled circulation. The second part of this chapter completes the picture. An economy can possess vast financial resources and still fail to function effectively. Liquidity trapped within balance sheets and markets does not sustain growth. It sustains appearance. Without circulation, money loses its economic meaning. It becomes static wealth rather than dynamic capital. This is not a temporary imbalance. It is a structural condition. And as long as liquidity remains concentrated rather than circulating, the system will continue to look strong while growing increasingly fragile beneath the surface. Growth no longer creates the future, it consumes it. This is the defining shift of the modern economic cycle, and it explains why expansion today feels hollow despite impressive numbers. What appears as growth is increasingly an advance against tomorrow, rather than the result of new value created today. The system moves forward by borrowing time, capacity, and resilience from what has not yet occurred. At the core of this dynamic lies debt, not as a temporary accelerator, but as a permanent substitute for organic expansion. In earlier cycles, borrowing amplified growth that already existed. Productivity gains justified investment. Rising incomes supported consumption. Debt magnified momentum that had real foundations. In the current environment, the sequence is reversed. Debt comes first. Growth follows as an accounting outcome. The foundation is no longer production, but expectation. Each new expansionary phase requires larger interventions than the last. Monetary easing must be deeper. Fiscal spending must be broader. Incentives must be stronger. The marginal effect of stimulus declines, even as its scale increases. This is not accidental. It is the natural result of a system that has exhausted easy gains and now relies on leverage to sustain motion. Productivity data reveals this exhaustion clearly. Across advanced economies, productivity growth has slowed despite massive investment in technology and capital markets. Output per unit of input rises marginally, if at all. Innovation exists, but its economic impact is diluted. Efficiency improvements offset costs rather than expand capacity. Growth becomes maintenance. Yet financial indicators tell a different story. Credit expansion remains robust. Asset prices continue to rise. Government spending fills gaps left by private demand. From a distance, the economy appears active. But activity is not the same as progress. Movement driven by borrowed resources creates velocity without direction. The intertemporal trade-off is unavoidable. When growth relies on future income, that future becomes constrained. Debt must be serviced. Obligations must be rolled forward. Policy flexibility narrows. Each decision made to support current stability reduces options later. The economy becomes increasingly sensitive to shocks because its buffer has already been spent. Corporate behavior reflects this shift. Long-term investment horizons shorten. Projects are evaluated based on immediate return rather than strategic value. Capital expenditures focus on preserving margins, not building new capacity. Growth initiatives are incremental. Transformative investments are rare. The future is approached cautiously because it is already encumbered. Households experience the same pattern. Consumption is sustained through credit, asset appreciation, and deferred cost. Education, housing, and healthcare absorb future income through loans and obligations. Living standards appear stable, but financial pressure accumulates. The present is financed by the future, one payment at a time. Government finances illustrate the macro version of this process. Public debt expands faster than underlying economic capacity. Deficits persist even during expansion. Fiscal space shrinks, policy becomes reactive. Spending supports current demand while increasing future constraints. Growth appears supported, but resilience declines. This borrowing from the future is often justified as temporary. Each intervention is framed as a bridge to recovery, a pause before normalization. But normalization never arrives. The bridge becomes the road. Temporary measures become structural. The future is continuously postponed. Markets adapt to this environment seamlessly. Expectations adjust. Risk is priced based on policy support rather than economic fundamentals. Asset valuations incorporate perpetual intervention. Growth projections assume continued accommodation. The system internalizes its own fragility and builds around it. This adaptation creates a dangerous feedback loop. The more the future is borrowed, the more necessary borrowing becomes. Without stimulus, growth falters. Without growth, debt becomes heavier. Without debt, stability collapses. The economy becomes trapped in a cycle where the cost of stopping exceeds the cost of continuing, at least in the short term. Historical comparisons offer limited comfort. Past debt cycles ended through restructuring, inflation, or crisis. Each path involves significant adjustment. What distinguishes the present is scale and integration. The global economy is more interconnected, more financialized, and more synchronized than ever before. Borrowing from the future occurs simultaneously across sectors and borders. This synchrony reduces the margin for error. When many actors depend on future growth that cannot materialize simultaneously, Competition for limited capacity intensifies. Policy choices become zero-sum. Trade-offs sharpen. Stability in one area creates pressure in another. The illusion of control persists because outcomes have not yet forced resolution. Growth continues, albeit unevenly. Markets function, institutions operate. But beneath this continuity lies a fundamental imbalance. The future is no longer an open horizon. It is a resource already consumed. The first part of this chapter establishes a critical premise. Modern growth does not build forward, it pulls forward. It transforms potential into present performance, while leaving diminished capacity behind. The system advances by eroding its own foundation, confident that the next intervention will arrive before the cost becomes visible. In the second part, the consequences of this strategy move from abstract to unavoidable, revealing how growth that eats the future ultimately undermines itself. As the future is pulled forward repeatedly, the consequences accumulate quietly. They do not arrive as a single breaking point, but as a narrowing corridor of options. Each year, each cycle, each intervention reduces flexibility. The economy continues to function, but it does so with increasing constraint. Growth remains possible, but only under specific conditions. Stability persists, but only with constant support. One of the most visible consequences is declining shock tolerance. In earlier eras, economies could absorb disruptions through adjustment. Demand could fall and recover. Investment could pause and resume. Today, even modest disturbances require immediate response. Supply chain interruptions ripple globally. Financial stress in one sector spreads rapidly. Markets react not because the shock is large, but because buffers are thin. The future that once absorbed volatility has already been spent. Debt dynamics amplify this fragility. When obligations accumulate faster than productive capacity, the system becomes interest sensitive. Small changes in financing conditions produce outsized effects. Servicing costs rise. Cash flow tightens. Refinancing windows narrow. Growth that depended on leverage suddenly confronts its cost. What was manageable becomes restrictive. What was postponed becomes urgent. Policy responses grow more complex and less effective. Lowering rates stimulates activity less than before. Fiscal spending generates diminishing returns. Each measure must be larger to achieve the same effect. This creates political and institutional strain. Public confidence weakens as interventions feel continuous rather than exceptional. Support becomes expected. Its absence becomes destabilizing. This environment distorts incentives further. When survival depends on accommodation, behavior adapts. Firms prioritize lobbying over innovation. Financial engineering outperforms operational improvement. Short-term gains are favored over long-term resilience. The economy becomes adept at managing appearances while neglecting foundations. Capital allocation suffers accordingly. Resources flow toward activities that benefit from policy support rather than those that generate sustainable value. Asset speculation outcompetes productive investment. Returns concentrate in financial channels. Growth becomes detached from contribution. The system rewards those closest to liquidity, not those closest to production. Internationally, the effects compound. Countries compete to attract capital by maintaining favorable conditions. Monetary policies converge. Fiscal pressures align. The global cycle becomes synchronized, reducing diversification. When adjustment finally occurs, it occurs everywhere. There are fewer external anchors, fewer independent stabilizers. Demographics add another layer of constraint. Aging populations reduce labor force growth. Dependency ratios rise. Future productivity must work harder to support present obligations. Borrowing from the future becomes more expensive when the future is smaller. The arithmetic becomes unforgiving. Growth projections assume capacity that no longer exists. Technological optimism offers partial distraction. Innovation is expected to resolve constraints, boost productivity, and create new capacity. While technology advances, its benefits diffuse unevenly. Gains concentrate among capital owners. Labor displacement offsets efficiency. The net effect on growth is modest relative to expectations. Technology delays reckoning rather than eliminating it. As a result, the system enters a phase of controlled deceleration. Growth persists but trends downward. Volatility is suppressed. Adjustments are smoothed. Crises are managed rather than resolved. This creates the impression of mastery. In reality, it reflects avoidance. The future is rationed carefully because it is scarce. Eventually, trade-offs sharpen. Supporting one objective undermines another. Inflation control conflicts with debt sustainability. Growth support conflicts with currency stability. Social spending conflicts with fiscal capacity. Choices that were once deferred become unavoidable. The cost of borrowing from the future can no longer be rolled forward indefinitely. This moment does not require catastrophe to be decisive. It requires recognition. When growth no longer delivers improvement, when stability demands constant sacrifice, when intervention becomes permanent, the system reveals its limits. The future, once an engine of possibility, becomes a constraint that defines the present. The central danger of growth that eats the future is not collapse. It is stagnation disguised as continuity. Life goes on, markets operate, institutions function, but progress stalls, expectations lower, potential contracts. The economy survives by consuming what remains rather than creating what comes next. This is the culmination of the process described in this chapter. Growth achieved by pulling forward tomorrow ultimately reduces tomorrow's capacity to sustain it. The system moves, but it moves in place. And the longer this pattern persists, the more difficult genuine renewal becomes. By the time the cost is fully visible, the future has already been spent. The end of the paradox does not arrive with noise. There is no single day when markets collapse and the illusion dissolves. There is no dramatic announcement declaring that the system has reached its limit. Instead, the paradox breaks through a slow and irreversible shift in behavior. The economy does not fall apart. It simply stops responding. At first, the signals are subtle. Growth forecasts are revised downward again and again, each revision framed as prudence rather than warning. Earnings remain positive, but momentum fades. Revenues rise in nominal terms while volumes stagnate. Employment holds, yet real income weakens. Policymakers reassure. Markets hesitate. The system continues to function, but it no longer accelerates. This is the moment when the machinery of perpetual expansion fails quietly. The tools that once delivered predictable results begin to lose effect. Lower rates no longer stimulate investment. Higher spending no longer generates durable demand. Liquidity injections stabilize markets, but fail to revive circulation. The levers still move, but the response is muted. The system absorbs intervention without transformation. What breaks is not confidence all at once, but belief over time. Investors stop expecting growth to return to previous trends. Businesses stop planning for expansion and focus instead on endurance. Households adjust expectations downward, prioritizing security over advancement. The collective horizon contracts. The future becomes shorter. Financial markets reflect this shift through behavior rather than collapse. Volatility may remain low, but valuations lose conviction. Rallies fade faster, corrections recover more slowly. Capital rotates defensively. Yield replaces growth as the primary objective. Risk appetite narrows. This is not panic. It is adaptation to a world where expansion is no longer assumed. Corporations reveal the change through strategy. Mergers replace innovation. Consolidation replaces competition. Cost control dominates executive language. Balance sheet strength is prized above growth potential. Cash is preserved, investment is selective. The emphasis moves from building the next cycle to surviving the present one. Governments face the same reckoning. Fiscal capacity is constrained by past commitments. Public debt limits flexibility. Political tolerance for continuous intervention weakens. Each new program requires greater justification and delivers smaller impact. Policy becomes reactive rather than proactive. Stability is maintained, but progress is deferred. Globally, divergence becomes more pronounced. Economies with structural advantages stabilize earlier, but do not lead. Those without buffers stagnate. Capital flows favor safety over opportunity. Trade slows not because of barriers, but because demand no longer expands. The world economy enters a phase of managed deceleration. The paradox resolves itself not through collapse, but through normalization of stagnation. High asset values coexist with low growth. Strong profits coexist with weak demand. Monetary and fiscal policy remain active, but expectations are subdued. The system finds a new equilibrium, lower than promised, but higher than feared. This resolution is uncomfortable because it lacks drama. There is no single villain, no sudden shock to explain the outcome. The illusion dissolves gradually, replaced by acceptance. The world is no longer collapsing in expectation. It is simply no longer growing in reality. The most dangerous aspect of this phase is misinterpretation. Observers mistake survival for success. Stability is celebrated as achievement. The absence of crisis is framed as validation. But a system that can no longer generate improvement is not healthy. It is constrained. Over time, this constraint reshapes social and economic priorities. Inequality becomes entrenched rather than debated. Mobility slows. Opportunity narrows. Institutions persist, but legitimacy erodes. Trust weakens, not because of failure, but because of stagnation. The promise of progress fades quietly. This is where the profit paradox truly ends. Profits remain, but they no longer inspire confidence. Wealth exists, but it no longer signals vitality. The numbers still rise, but they no longer convince. The world appears rich, but it no longer feels dynamic. The collapse, when it comes, is not a crash, it is a realization. Growth that depended on illusion cannot be restored by belief alone. A system that consumed its future cannot simply wait for another one to arrive. The paradox breaks when the question changes. Not when markets fall, but when expansion is no longer expected. Not when profits disappear, but when they cease to matter. At that point, the illusion ends, not with fear, but with clarity. And clarity, once it arrives, cannot be undone. The profit paradox is not a prediction. It is already here. Growth that consumes its future cannot continue forever. Wealth without circulation cannot sustain society. Profit without strength cannot survive change. The system will not collapse overnight. It will simply stop delivering progress. And when that happens, the most dangerous question will no longer be when the crash comes, but why we believed the numbers for so long. Watch closely. Understand the structure. Because the end does not arrive as a crisis, it arrives as normal.